All right, guys, this is being recorded. Something I mentioned at the beginning of all webinars is watch this webinar again after watching it through one time, because the first time through, you might miss some of the nuances of this strategy. It's not just going out there and selling a short put spread as you might find online or some other people talking about it. I come up with specific rules that you probably should follow in order to increase your probabilities of success. There's a lot of things that can go into this, and I don't want you to miss those nuances. It'll also help you remember it long term if you watch it relatively soon afterwards. So we are going to be talking about implementing this strategy into our portfolio, and it's a little bit different than what I usually talk about, just trading the short put spread. This is an idea where we're building on a portfolio, right? So we all kind of have a portfolio out there, maybe a longer term type of trade rather than just a quick move off of a bull assumption. This is going to be maybe for a longer term, dollar cost averaging, things of that nature. So we're going to talk about that a little bit more specifically, and I'll try and play back and forth on those. Let me get a couple of things out of the way real quick. My name is Eric Wilkinson. For some of you new people out there that may or may not recognize me from mainstream media as the Wolfman, where I've talked about everything from economic to geopolitical and market analysis. I started out trading in college with a psychology degree, switched it over to finance, and then moved straight to Chicago after graduating and worked on the floor for a little over 20 years. In that time, I've traded everything, and I'm still trading my own money, to be quite honest. In that time, I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all these products in just about all market conditions. But we do have to go over this disclaimer, and it basically says any opinions, news, research, or analysis or other information contained in this webinar should not constitute investment advice. This is all about teaching you guys. We are a teaching company. I'm trying to teach you guys how to swim. I'm not here to swim for you. I don't like the herd mentality or you guys lemming off the cliff with whatever trade I do. At the end of the day, I want to teach you guys how to think for yourself. So when you come up with an assumption, that you guys can take advantage of that moving forward. Also, do your own homework. Please remember, past performance of any trading system or methodology is not necessarily indicative of future results. All right, and you can follow us on Twitter. You can follow me at Wolfman's blog and our parent company at ProTrader Strat. And we have been pushing out a lot of content on Facebook, so you can follow us at ProTraderStrategies.com on Facebook. So some of my daily market commentaries where I talk about all my trades, when I put them on, win, lose, or draw, you guys. I'm not cherry picking any trades. I never do. I talk about the trades the day I put them on, and I talk about them when I take them off, whether they were a winner or a loser or how I'm managing that. As a matter of fact, I talk about probably the losers more often than I talk about the winners, because those come and go. You don't learn anything a whole lot. You don't learn a whole lot from the winners, but those losers, how you're managing it, and all of that is something that I like to talk about because we're all going through that. All right, Trevor, I do have losers. And I have some winners that feel like losers, like my Boeing short. It was a winner, but it sure felt like a loser. All right, so short put spreads. It is considered a bull put spread. Some people call it a credit put spread, but I always was brought up knowing it as a bull put spread. We're always going to receive a premium, and we're going to take advantage of time decay because theta starts ramping up. So we're going to try and hit that sweet spot of theta decay, and we're kind of coming right into that whole move. And volatility, vega contraction, that's pretty important. It's not going to be as important in this webinar as generally speaking. So I'm going to kind of draw a line through that because I want us to be thinking about, we're thinking more about dollar cost averaging, okay? So it's something that we might want to add to our portfolio, and that's why we're implementing this into our portfolio. So dollar cost averaging, we own this stock. We think it's at a good level. It's something we want to add, but, I want to buy it here. I want to buy XYZ at this location, but if this thing really just takes a tank, then I don't want to be in it. So that's the beauty in this trade. The bull put spread or the short put spread versus just going out and selling puts. Now, the selling of the puts, I think you get a little bit better strike location. That's usually around a 10% correction in the underlying. But this one, if you're really worried about some kind of black swan event and don't want to be buying at all-time highs where we're kind of at right now across the board, then you can limit your risk with this. So you can be like, all right, I want to add here, but if there's a black swan event, I really don't want to be involved in it, and I'll buy it much lower if there is a black swan event. So it's pretty easy to figure out what our max profit and all of that stuff is. Our max profit is going to be that short put minus the long put, which is a debit. So let's just say, you know, XYZ right now is trading at $105. Okay, just to give an example. If we had our short put, we'd be probably selling right now the March, you know, 100 puts, and then those are the ones we're selling, and then we would be buying the 95 puts. All right, and then that width of the short put minus the long put is $5. Well, I don't know why I don't have that in there, but $5. And then we also need to take out our credit. So we get a credit of probably about $1, let's call it $1.50. All right. So our max profit is that credit. All right. Our max profit is going to be the credit we received on that. That was a little odd. I missed something there for some reason. All right, our max loss is the difference between those strike prices minus the credit received. So in that example I gave you, we were doing the 100 puts minus the 95 puts, right? And then minus that credit received, which is, let's just say it's $1.50. If we did that, then our max loss would equal $3.50, right? Because we've got a $5 spread here minus that $1.50 credit, which is our max profit, and then our max loss would be the $3.50. Pretty simple so far, right? All right, and then our break even is that short put minus the credit. So in our example, we were looking at the 100 puts. So if we had the 100 puts here minus that $1.50 credit, right? $1 minus that $1.50 credit gives me at $98.50. So when XYZ goes down to $98.50, that is equal to my break even. All right. So our break even would be as simple as that short put that we sold minus the credit, and then that gives us where our break even is on this. So once the underlying hits $100, we still are profitable. All right. We're still profitable if we put this stock, say for instance at expiration, right? This underlying is trading $99. So at the, you know, at expiration, we're seeing it at $99. Well, we're put the stock, we'll own the stock at $100. So you might say, yeah, I'm losing $1 on it, but remember your break even is still below where it's currently trading. So you're still profitable because you always get to keep that credit. That credit's going to stay in your pocket. That lowers your the price on what you paid for it. You're consistently going to do that and lower where you paid for it. All right. So I'm at a loss for a word right now, and I can't think of what I'm trying to say. Lowering your basis. That's what I was trying to think of. You're lowering your basis by using options. You know, if you were thinking I wanted to buy this stock at $100, right? Well, when it goes down to 99, you had already bought it at $100 anyway. So try and separate yourself from old school mentality of just going out and buying that underlying. You know, if you want to buy a stock, you should definitely be thinking about selling some puts or a put spread in order to facilitate that. Because if you're just putting an order in the market, waiting for the market to come to you, well, you're not getting paid for taking that risk. Whereas if you are selling options, selling puts, and it never happens, you got paid for being in the markets and taking that risk. So that is something to write home about. You know, if you wanted to buy this stock and you consistently did this month after month after month, wanting to buy it at $100, well, you're going to get paid for taking that risk on rather than just leaving a limit order in there to buy at $100, okay? So not all options are created equal, you guys. We have to kind of figure out which options we want to actually trade. Something like there are stocks out there, let's say, you know, AutoZone. It's a stock that everybody's pretty much heard of, but there's not a lot of participation in the options at this point anyway. And we can even look at like Priceline. When Priceline was the ticker symbol, it actually had a lot of good options trading. They switched it over to booking.com, and booking is the ticker symbol. Well, they've lost a lot of open interest in the options. So those markets have gotten really wide. And if you're a newer trader, I want you to avoid the pitfall of getting in there and trying to figure out where the pricing is. So I've come up with a real easy rule of thumb to use when you're trying to decide whether there's a lot of volume and open interest, or a lot of eyeballs is the way I used to, or I like to refer to it as. You know, if there's a lot of eyeballs in there, that means there's free market price discovery going on in full swing. So my rule for this is basically, if we're looking at a stock that is less, if XYZ is less than $100, then we need to have in the closest to expiration, the closest monthly to expiration. Yeah, somebody could say, well, hey, you got February there. Well, there's only 8 days left in February, and most people, most of those eyeballs are looking down at the 35 days to expiration. That seems to be where the most open interest ends up showing up. Yes, there's people playing out here, but those markets are a little bit wider, and I talk about that in different webinars. I don't want to get into too much there, but we want the ones where everybody's participating. So if it's less than $100 stock, then we need it to be equal to or less than 10 cents wide to the bid offer on these options that are just out of the money, or, you know, at the money for the most part. The deeper in the money, you can see, isn't going to fit that rule. But, you know, Wells Fargo, just out of the money or slightly in the money, you can see fits that rule across the board. All right. If one or something like that, 1 or 2 doesn't fit that rule, then you can, you know, say it's like a yellow light. A green light would be all of them across the board do it. Now, if we're looking at something that is more along the lines of, and this is during open market operations, the market's closed right now, so it doesn't always fit the rule after the close, but if it's greater than $100 stock, like Deere, so if it's greater than $100, then basically we're going to do this thing where we just move the decimal 3 ticks to the left. All right. So in this case, we'd move it 1, 2, 3, and we have 17 cents. So we look down here to the options that are closest to expiration, and we're going to be looking, or at least the ones where the most eyeballs are, which is that one that is about 35 days to expiration. And you can see that it is fitting that rule of being, well, that one's not necessarily, but we are after the close on these, on a couple of them. And, you know, remember, when you guys, after the close, you hear your platform just go like cling, and everything's getting like closed out, or they make those noises that shows you that all your orders got canceled. So just make sure it fits that during the open market operations when you're looking to trade this, okay? And the reason is because if you come in, if this is 385 bid at $4 and you come in at $4, well, if there's a lot of eyeballs in there, you'll probably see this start getting bid up a little bit. You'll start seeing maybe a 390 bid come in there. The market starts tightening up because, for one, people are falling over each other to try and get their order on the market, right? It's they don't always wait for the market to come to them. They gotta want to put that trade on. We used to say on the floor, you know, do you want the penny or do you want the trade? Well, a lot of people are willing to give up those extra pennies to get the trade or get their market represented or get their order represented on the market. So, so if it's, like I said, if it's less than $100 stock, then it needs to be equal to or less than 10 cents wide. And if it's greater than $100 stock, then we're just going to do this little thing where we move the decimal place. All right, 3 ticks to the left. And then that's a pretty good representation. You know, you can look at like Chipotle and any of those other ones. Right now, Tesla is a little bit wide, but volatility is through the roof on that one. So the markets have gotten a little bit wider, but generally speaking, Tesla, even at these levels, will fit that rule of thumb, just moving the decimal place. All right. So when we're looking at the right strike on this, what we want to do is we're going to end up starting around the 36 delta, right? Now, when we were doing the short puts, we were looking at the 16 delta. This one, because we need to get a credit, that's worth our risk, all right? So the 36 delta seems to be the real sweet spot for that. It's going to equal to about a 65% probability of success, all right? Of a winning trade. So that's the way the math ends up working out. When you do it in implied volatility that's really high, those get a little skewed. It actually gets better for you. It's more of like a 70 to 75% probability of success. And more importantly, though, we want to collect somewhere between 25 and 33-ish% the width of the spread, all right? So if it's $1 wide, you know, you're looking to collect 25 cents to 33 cents. If it's $5 wide, you're looking to collect somewhere around $1.50 or $1.25 to about $1, what is that, $1.60 or something like that, okay? $1.50 to $1.60, I should say. Somewhere in there is the best one. The lowest I'll take is the 25%. You know, the best case scenario is about 33%. Okay. All right. So I don't normally do this with trades. I usually wait till the day after. But if you guys have been watching the daily market commentaries, I've been waiting for a little bit of a pullback in Microsoft. And today we got, well, the last day or so, we got a bit of a pullback today. It was coming off a little bit. I thought it was at a good location that I was wanting to take on. So I ended up putting this trade on today. I didn't get it for $1.67. I actually only got $1.60 credit by the time I actually implemented the trade. But what we're looking at here is that 36 delta. And I should have switched it over to the deltas on this one. But basically, I was looking at about a 38 delta on this one, and this one, it was about a 25 delta, I believe, at the time. So what we're doing is we sold the 180 puts. You know, it's a $5 move to the downside. I'm bullish in Microsoft. My thinking is if it comes down to $1.80 or somewhere in this range, that would be the wheelhouse where I'd want to buy it. Why so close to at the money? Well, I'm $5 away, so that's a pretty decent move. And the reason why is because I want to make sure I get about 33% the width of the spread. So that's part of my mandate here. So I'm starting out at around the 36 delta. And, you know, deltas are the deltas, and those are the deltas equal probability, right? Trevor, I know you've watched this. So, you know, if we're looking at this, you know, a 36 delta is basically equal to a 36% probability of being in the money at expiration. So now my probability of getting hit on that 36 delta is about, you know, close to 70%. So I could get clipped on it. The market coming down and those going in the money. And because this is a defined risk strategy, I'm willing to take my credit, play out these probabilities. I'm not going to close this trade out. I'm going to wait it out. Beside the fact that I'm willing to take this into my portfolio right now. If it's below 75 and there's only a couple of days to expiration, I'll probably close this trade out for a loser because my thought process is if it goes down here, you know, I don't want to be involved in this trade below 75. So if we go and take a look at the platform, I'll pull up the regular platform for this. Let me just take a look at the charts here. So if we look at Microsoft, my thought process is, you know, I think it's going to hold this 80. It's kind of bounced on it a couple of times, but if it wants to go down and cover this gap, who knows where it's going to go, right? So that would be where my $75 is, right? My $75 puts. I don't want to be involved in this if it's really topped out and starts trading much below this. I'm bullish in it, so I think that the market is going to start turning around. So I'm expecting a bounce in Microsoft, correct, Trevor? So you're expecting a bounce in Microsoft. Yeah, and I'd be happy to own it. They came out with really good earnings. I think that they're going to do well. So it is something that I would add to my portfolio. Now, if it starts trading down here, you know, below 75, then I don't want it necessarily, right? So that's why I'm doing it as a defined risk strategy. Or if there's some kind of black swan event that really causes a snafu with Microsoft. I can't think of one right now, but, you know, who knows what could come out, and maybe it drops down to 62, 63. Well, I've limited my risk. I did lose a little bit of money on this trade, but at the end of the day, if you were just to go out there and say, I wanted to buy Microsoft if it gets down to about 180 and you put a limit order in there, well, you're going to get clipped on that if the market tanks anyway down to 665. This way, I have the choice of whether or not I want to buy that underlying still, all right? So, and it's got a high implied volatility. If this volatility starts coming out on this trade, you know, there's no binary event in the time that I'm going to be involved. There's a clean slate here. So I do also expect volatility to come out. So I'm going to be able to get that collection rather quickly if the market continues to, if it bounces and volatility comes out, all of those things being equal, it will help me. So with this trade, though, you know, we are looking at trying to get in with that 36 delta, and I have it on the deltas here. So obviously it's slightly lower than where I first got into this, but at 36 delta is where I said I wanted to start out with this. And the, you know, what did I say about the 26 delta is probably where I'm going to be defining that risk. Now, that's right in line with where we're at. As a matter of fact, the pricing, I'm probably at a scratch right now on the pricing, the way it looks right now. That if I just sold this and bought that one, you know, it's right there at $1.60 where I got in. So, you know, I'm at a break even, or where I put it on anyway. My break even now, remember, is that $180 minus the $1.60. So my break even is at 178.40. So if I put this stock and it was trading, you know, 179 on March 20th, then, you know, my break even is still below where the underlying is trading, right? And at the end of the day, even if it's trading $76, I'm going to be happy with owning Microsoft at that level, at 178.40, you know, because that's where I've chosen to put that on. Now, obviously, in the next 36 days, if it's trading 65, well, I haven't taken that risk. I could go out there and sell another put spread or do something else to add that to my portfolio. Yeah, I lost a little bit of money on this trade, but I'm getting better strike location now. And that would be the difference as to why I would want to do the spread versus just selling the puts, right? Because when we were talking about just selling the puts, we would have been talking about selling like the 170 puts or something like that. That makes sense? You know, and if it goes down to 100, then I can easily dollar cost average down there. All right. So one thing Trevor was asking is why so close? Well, we're going to take a look at the standard deviation, right? This is important for us because what we're looking at is this half standard deviation. So basically my probabilities of the underlying, actually my probabilities of the underlying are, you know, this is the the area where I'm willing to buy it, somewhere between a half a standard deviation and 1 standard deviation away. It's is kind of my buy zone. Out here, I don't have to worry about taking this trade on, right? And if it goes this way, then I get to keep the cash. The cash is mine up here. You know, I get that credit. That credit is mine if the market just continues to move higher. So, but if I want to buy it and I'm thinking, okay, I'm waiting for a little bit of a move. Well, this is kind of in and around the wheelhouse of where I'm buying it. So you can see I've got a short window where I'm willing to buy it. We're going to be selling this short put at the half standard deviation. So if we basically take 15 plus 9 plus 4 plus 1.5 plus 0.5 plus 0.01 and continue out down the standard deviation curve, you will end up seeing it ends up being very close to around 36%, right? And like I said, percent and volatility, or percent and delta is one and the same. Now, if you saw volatility start to increase, or when volatility is really high, this bell curve actually starts looking more like that, all right? And that half standard deviation away is probably going to end up being a little bit further away from where the underlying is trading. So volatility ends up being like a weight on the bell curve and pushes it down. It kind of squashes it out, all right? And there's also other types of bell curves as well, which is a little bit more normal, or this is actually a normal quote unquote bell curve. But then you can have negative skew where there is skew to the put side, where you can see the longer tail where the XYZ is trading right there. The longer tail of the curve goes out to the puts. And if there's positive skew, then, you know, this is on the call side, the longer end gets pushed out. So that's how we can talk about with those standard deviations. Like if we're looking at about a half standard deviation, that could be where your half standard deviations lie from where the underlying is, all right? So this could end up being a half standard deviation, and that's probably not completely accurate, but you can see how this is a little bit further away from where the underlying is currently trading if you drew a line kind of straight down, right? And I've got some examples of how you can see what the skew is. So this trade is if you want to own Microsoft. Yes, I'm thinking when I'm going into this trade, I'm thinking I want to add Microsoft to my portfolio. And if it doesn't come down to where I want to buy it, then I'm just more than happy to take that credit. You can look at it like it's an extra dividend or something like that. So more than likely, I already have Microsoft in my portfolio, and I'm just trying to do a dollar cost averaging. Dollar cost averaging doesn't have to happen below where you currently own it. If I own Microsoft at 100, and I've owned it for let's say a couple of years now, and I decided I wanted to buy some more, well, dollar cost averaging still works even when the market is higher than where you currently own it. You can still continue to add that. Yes, it averages it out a little bit higher than those hundreds, but you're also adding more to your portfolio, right? More quantity to your portfolio. It doesn't always have to be dollar cost averaging when it's below where you originally bought it. So this is a normal bell curve. So like that first one that I showed you. And the way to figure it out is to kind of go equal distance away from where the underlying is trading. And we're going to say we're trading, the current one is at the 145 strike. So those are basically the at the money. And if I go $5 lower, so I'm just taking a look at all of these. So if I go $5 lower on this one, the 140 strike versus the 150 strike, you can see that the pricing is very similar, right? And if I go, $10 lower, and I'm now looking at these and I look at the $10 higher, you can see that the pricing on these is very similar. Now, this is an older example. It's hard to find perfect examples. So when I do, I'm going to hold on to those. I'm not trying to cherry pick this other than any other reason to say that the skew on this is like that normal bell curve, right? So it's a relatively normal bell curve where we have on that original example where they're pretty in line. Now, if I wanted to look at something where there is skew, sometimes you get a call skew, where it means that these are going to be a little bit more pricey. So if we're looking at right in between these, because you can see we're trading at 32, close to 32.50. So it's landing right in between these, all right? So let's just go down to the 525s. You can see they're trading right in and around that $25. And if I go up to the, what would that skip to the 40s, you can see that that is very close, but a little bit skewed to the call side, right? These are a little bit more pricey than these are here, right? The 35, or if you go to the 30s and the 35s, you can see that the 35s are a little bit more pricey than these that puts that are basically $2.50 away. As a matter of fact, it's probably closer to this strike than it is to these calls, right? But these are actually more expensive. So that's where we saw that bell curve where on the call side, we had the long leg kind of thing, all right? So it's more of a longer tail to the call side there. And then if we wanted to look at some put skew, again, the underlying's trading right around, 210. So if we were looking at the 210s being the strike and the put skew, so look at the $10 lower ones, those are $2.78. And then we look at the 220s, and you can see that these are just slightly cheaper, all right? So that's just an idea of that put skew where we have the long leg kind of coming out like that, all right, for the put skew. That's a little bit dramatic, but you kind of get my idea where the underlying was trading here. You can see that a standard deviation, the deltas are a little bit off in a sense. So you can look at that and find some skew that can help you determine really directional assumptions in the market. All right. So usually if there is put skew, that means it's a little bit more bearish. And if you see the call skew, that means it's a little bit more bullish, because when there's put skew, it means people are buying up those puts for some protection, and it drives those prices higher. And when there's call skew, it's because people are going out there and buying the calls. Like right now, we probably look at Tesla, and I'd almost assure you that Tesla has call skew because people are jumping on board to try and buy some calls in Tesla to take advantage of that upside. So you can see a little bit of the market assumption and directional move there by looking at the skew. How would you restructure the trade on the strikes or delta and durations if you don't want Microsoft? Well, if I didn't want to take Microsoft into my portfolio, one of the things with trading options, especially with selling options, if you're selling a put, my thing is you're always in the back of your mind thinking, this is a strike location where I would buy that underlying if it came down there, all right? So anytime you're selling options, or if you sold calls, you're thinking, I would short this underlying there, or I would be happy for somebody to call my underlyings in my portfolio away from me at that level. Maybe it's an all-time high for the calls, or a 52-week low in the puts. You'd be happy to buy something at the 52-week low probably, right? If I didn't want to add it to my portfolio, then you're going to be wanting, and you had a bullish assumption in this, you're going to be wanting to buy some calls. Now, I have specific rules in and around buying calls, Trevor, and that's going to have really low volatility, all right? So make sure that you follow the rules of my long call strategy on that type of scenario if you didn't want to take it into your portfolio. The other thing you could do is if it goes down there and you don't want to take it into your portfolio, you would cover the trade, right? You would just get out of it if it was looking like you were going to be put that stock or something, okay? And if you didn't want to take it and it was a profitable trade on this short put spread, then you would just cover it as well for a profit whenever you had that opportunity. Now, hey, how you doing, Alexander? Welcome. So picking the right duration. I kind of mentioned this a little bit with theta decay. We want to take advantage of theta decay. And this is a representation of the at the monies, the right there at the monies. We're going to be slightly out of the money. We're going to be looking at the 36 delta. Don't forget that for that short put. Our short put is going to be about the 36 delta. So this graph would be a little bit different, but I just want you guys to wrap your heads around theta decay and what happens. We want shorter duration. So we're going to be looking at 35 days to expiration to implement this strategy. So when I'm, going through all of these rules, where's my cursor? It's getting lost for some reason. Where are you? So when we're looking at, when I'm talking about duration right here, I'm going to say we want 35 days to expiration, right strike location. We're going to start with that 36 delta short put and right underlying, less than or equal to that 10 cents kind of deal, or move that decimal place 3 ticks to the left. But when we're talking about this, the reason why we want this 35 days to expiration is because we get this theta decay happening, right? This ends up being a trade. We want shorter duration, continue to collect this credit. If we own XYZ in our portfolio, we want to do some dollar cost averaging, but it doesn't happen for us. It doesn't come down and clip us. We don't get to buy that stock at our optimal level. Well, we want to get a credit for it, all right? I don't want to be in this forever necessarily. I would rather just keep hitting this 35 days to expiration and month after month after month collect a credit, right? That ends up lowering our basis on the trades that we own, the XYZs we own. If I, am looking at that $100 stock, right? Maybe I bought let's just say we bought XYZ at 75 and now it's trading 100, or maybe we bought it at 150 and now it's trading 100, whatever the reason is. And now it's trading at right around, $100. Well, I could say, you know what, if it drops back down to $95, that's where I want to buy it. I want to buy it there. So you sell the 95 puts, right, on this. Well, if I'm selling something and I'm collecting a credit for it, I want to do it in this zone where I can see that theta decay happening, because then I get that credit. Remember, we'd be doing it for I'd get about $1.50 credit on this spread if I did the 90 put spread. All right, I'd get about $1.50 credit. Well, ultimately, if it never happens, I get to keep that credit. So, that credit kind of goes into my piggy bank. Well, dollar cost averaging also works like this. Now, if I got to keep that credit, synthetically speaking, I own this at $73.50, right? That credit goes in there on that trade. And if I ended up buying it at 95, right, I still got to keep that credit. So synthetically, I bought it at 93.50 on that one. So I bought that one at 93.50, and this, what is it, the $75 that I did it originally at, basically then you do your dollar cost averaging there. So what are we looking at? $138.50 divided by 2. So now my dollar cost averaging puts me somewhere at around, did I do that math right? No, $1.60. So now my dollar cost averaging, I own it at about $84.25. So that's my average, So we're thinking about dollar cost averaging here. And you don't have to necessarily double up, if I own, let's say, I own 500 and my average is 75, I might be doing this as a 2 lot, selling 2 and add, 200, sell 2 puts, which is equal to 200 XYZ. All right. So that I don't have to always double up on that. And then you take that into account on your averaging. Your dollar cost averaging will be lower than that, but you get the idea. We want to continue to do this, stay consistent with it, and get that credit. If you buy it, then you're more than happy to take that into your portfolio. So this is just a better way to add to an overall diversified portfolio of stocks that you already own. All right. Now, picking the right environment, this isn't as important as if we were just to do this as a trade, right? The environment will help. And the environment is if we have implied volatility percent higher or high implied volatility. If the implied volatility is really high, that pumps up the premium. We're going to end up getting more money from it. And remember what I said, a normal bell curve kind of looks like that, right? If we think about this as volatility, the bigger volatility gets, let's just say now volatility goes to here. Now we got some volatility. Well, think about that as like a weight. Now my bell curve is going to end up being a little bit more stretched out like that. It squishes it down, all right? So, like I said, you're going to get strike location that's further away. So it will help you. Microsoft has pretty decent implied volatility right now. You say, yeah, you're pretty close to where the underlying is, but I'm also only a 36% probability of being clipped on that. So that's something to think about. Now, a little bit further on this implied volatility, again, this is an older example. If we looked at the Pepsi trade in 128, I'm trying to find stocks that are pretty equal between, say, IBM and, at this time in life, they were trading very close in price, right? So if we looked at the pricing being very similar, but the volatility ranges where implied volatility for IBM is really high, and trying to forget about where the coloring is here. We look at these strikes, like let's just take a look at the 120 strikes. They're trading around 180 on the puts, and then the 120 strikes here with really low implied volatility, it's only trading around $1. So implied volatility going higher will help you. Keep in mind, we're probably still going to be looking at these 125s here. That's about that 35 delta. But if we go over and look at the IBMs, the 125s is a 36 delta, and you can see we're getting paid a lot more for that same strike location. So the spread here would be a little bit better. You're going to get a little bit better credit. That's all I really want to say with that. All right, now expanding upon what Trevor was saying, the exit strategy for me with this spread, if you were trading this as a trade for the bullish move, you might want to look to take about 50% of your max profit. With this idea of implementing this strategy into our portfolio, we're trying to lower overall basis on an underlying we have. My exit strategy on this is I'm going to take that full credit. I'm going to try and take it in probably about the last 7-8 days. If it's only trading for a quarter or something like that, I got $1.50 or $1.60 for this, and it's only trading for 25 cents. I'll probably look to cover this trade. I'll just take that credit. And, if the market corrects back down to where I originally bought it, then I might add this trade on again in the same month and get another $1 credit or something like that. All right. So with that being said, you're going to be wanting to take a max profit of somewhere about 75% is where I would be looking. If I put this trade on, I wanted to add it to my portfolio, and it was I had collected all 75% of where it was originally trading. Then I might look to cover that, keep that credit. Remember, you lowered your overall cost basis on it. And if the market pulls back, then throw that trade on again, at the same strike locations. Try and continue to add those credits for you. But, if the market, you sold that put spread and the market just took off straight up, well, you got that credit. I'd be hard pressed not to cover it. And then when the market pulls back down to where you originally did it, just sell another put spread. I want to still buy it there at those levels. I want to still dollar cost average as long as your assumption in this underlying hasn't traded where you want to continue to add to your portfolio, then absolutely go in there. If it, was, we were looking at one of these examples. Let's just go back to it. I wanted to buy it at 125 right now, and let's just say the market rallies up, and now it's trading, $135 or something like that. Maybe it's actually, let's just say $150, right? So it made that market move. I didn't buy it. Well, I'd probably cover this trade. Well, now it drops back down to trading around $130 again. Well, I would probably go in there and sell that same put spread again. All right. And if I got clipped on it, well, you got to keep the credit on this one. You added another credit on that one. You're overall continuously staying mechanical. And I can't emphasize that enough, you guys. Like, stay mechanical with your portfolios consistently, especially with all of you guys that are building a portfolio from scratch or adding underlyings to your portfolio that you want in there for the long term. This is a great strategy to add to that portfolio. This isn't what we're talking about when we're just talking about for trading purposes. This is for a long-term portfolio that we're adding stocks to it, all right? If you can trade your like 401k or something like that, this would be a great strategy for something like that. So let's take a look real quick at a couple of other examples besides the one that I already put on. So this is kind of the time where I say, hey, you guys throw out some different underlines that you want me to take a look at. And I see Apple already. So let's take a look at Apple. Apple's something everybody likes to add to their portfolio, right? I mean, it should be basically, theoretically speaking, in everybody's portfolio. So we're going to take a look at this. First thing we're going to look at is Apple. It's $300 stock. It's over $100. So we move the decimal 3 ticks to the left. We're looking at about 32, 33 cents to the bid offer. And you can see that Apple pretty much fits that rule on 35 days to expiration, even after the close. It's fitting that rule. So we're good there. Now, what was my next thing we were going to look at? The strike locations. The dogs understand what the Ring doorbell does now. So the next thing we're going to look at is strike location. I said we're going to start out with that 36 delta. Well, we don't have exactly a 36 delta. So we're probably more than likely, Trevor, going to have to go a little bit closer to where the underlying is trading. So you usually have to default a little bit higher. We can try it out with the ones that are a little further away. So sell those, buy those, and you can see that it's $5 wide. What's my rule? It's 25% the width of those spreads. So on the lowest end, this is going to fit that rule, right? $5 wide, $1.25 is kind of my lowest end, so that will fit. But if I was thinking I wanted to do something around the 320s or something like that, that's the perfect wheelhouse. That's right around that 33%, the width of the spread. That's usually where I'm looking to get that credit. I'd rather do that credit than probably a little bit further away. But if you're a little bit more risk adverse and think that there's a little bit of play, you're looking at it, well, you're thinking, well, 310 is kind of where I'd want to buy. That's in that lower end of the range after their earnings that I'd rather buy it at, then absolutely do that, and then you don't have that risk if it really started to drop. Next one I saw was Cisco. So let's look at Cisco. No backslash. All right. So, anything under $50 is going to make this a little bit more difficult. You're going to be very close to where the underlying is trading. So let's keep that in mind. Implied volatility, I'm not too worried about, but Cisco, it's under $100 stock, 35 days to expiration. We're going to be looking at the bid offers. Yeah, you can easily see there's a lot of eyeballs in here. I mean, we're even getting 2 cents wide there. So Cisco's probably not going to work out for us very well. We're only going to get about 27 cents on this. So I might just, if you're thinking I'd buy it in and around where we're currently trading, you could throw it in something like that. Like I would want to buy it today after they just had their earnings. Like this is a great strike location. It's right there at the point of control. You could easily see that being a great place to buy it. That's where the market finds value. So, 47.50 might be a very good location. And if it rallies, at least you're getting paid for this, for taking this risk. You're actually buying it, at $46.80 or something like that, right? $46.70. So, you're getting it a little bit below where that point of control is. That would be something you could definitely take a look at as well. Just know you're selling in the money put, so you're more than likely buying it right here where the underlying is trading. But, if you want to do dollar cost averaging, rather than going out there and just buying it at $47.50 right now, why not do this trade? If you're thinking, I want to buy it today, it's had that pullback, I'm still bullish in it, I own it, I want to add to it. Why not do this trade? And get that credit if it starts rallying right away. It's definitely should be a consideration for sure. Somebody else said Facebook. And something, I would pick something like Facebook did just have earnings. Nvidia, I guess today would have been an okay day to do it. But, I wouldn't want to do this in something that has earnings, way down the road. I don't know when Ulta's earnings are, but, say, for instance, their earnings were way down here at this area, and that's a long time before to put that trade on, I think, ahead of earnings. You're just going to see volatility probably continue to expand or something like that. So it's good when you're doing this in a clean month. If you're doing it for an earnings trade, I have rules for that we'll talk about here in a minute. But what was I looking at? Somebody said Facebook. All right, so Facebook, let's take a look at this one. Facebook, $200 stock. So we want these move it decimal 3 ticks, so 21 cents. You can see Facebook fits that rule as well. There's no 36 delta, so I'm more than likely going to have to move a little bit closer to where the underlying is, but let's just take a look at it anyway. Selling the 205s and buying the 200s. It's a little bit cheap. I'd maybe do something like this and rally it up to the 125 minimum, and you get basically probably a 20 or 30 cent pullback in Facebook during the day. You'll probably get filled on this trade. So that would be something I would consider. But if you're thinking I'd buy Facebook here, I'm ready to buy it. It's done pretty well. Then you can get a little bit more aggressive with it. If you're thinking I would buy it at 110, then build that out, and you're going to get that nice credit that I talked about. So a lot of times you're going to have to go a little bit higher than that 36 delta, but sometimes you'll be able to get it a little bit further out. I missed the early part, got in late. What's the rationale of the 36 delta? 36 delta is that, basically we're thinking dollar cost averaging here, right? So we're adding to our portfolio. So a 36 delta, 1 out of 3 times you're going to be able to add this to your portfolio. So if we think about it throughout the year, I'm not always just doubling up. So if I already own, 500 shares or a couple hundred shares of Facebook, I'd probably be doing, 1 or 2 lots on this. But it's something we want to add to our portfolio. And if we don't get to buy it during this option cycle, then we get to keep that credit. That lowers what we already paid for our underlying. It's like an extra dividend. But the 36 delta is also the sweet spot to be able to get the credit that we want to receive, which the sweet spot is about 33% the width of the spread. So it's a $10 wide, 33% the width. That spread is somewhere right around $1.60 something, right? So it's $1.65 is basically right on the nose, I think. I'm doing the math correct in my head. The minimum I would take on one of these strategies, which was the going a little bit further out, is 25% the width of the spread. So I would need to at least collect $1.25 for that. So there's a bit of a range there, depending on how aggressive you want to be with adding this. You know, if you're looking at the 25%, it's a little bit further out than that delta there. All right. Any more questions on that? All right. Well, so this is what we're doing right now. This is the offer. We're going to be giving away the options for earnings webinar for $36. I basically go through all of the best strategies I have found for trading earnings. As a matter of fact, if you guys are watching the daily market commentaries, I'm talking about earnings trades right now. And this really goes into more specifics on duration. The duration is going to be a little bit different. I talk about the pitfalls you can get into if you're listening to the guys on mainstream media that are talking about these earnings trades. You guys, their option strategies are not the best strategies to be putting on during earnings. And I talk about the pitfalls that those guys are going through. You know, you really have to have a lot of things go your way if you are trading the earnings the way these guys on mainstream media are talking about it, versus, you know, with the strategies that I'm putting on here, I can be directionally wrong and still make money on these trades. So I'm talking about the duration, strike location, all of that stuff, the environment we need to have, how many days before that earnings happens do we put this on? It's like a specific time frame. So all of those things are different than what I normally teach. This is a great strategy for $36. If your guys are watching mainstream media, that $36 education, you're gonna pay for that in a losing trade right off the bat. So if you guys learn anything at all, if you guys like how I teach, you know, if this starts really jiving with you, starts to make sense, then take advantage of this. And I'll throw this link in the chat window here in a second. Somebody's asking for it. Let me find my window for it. Earnings trades. So this is the other link. So I'm going to copy and paste this into the chat window. We've been going back and forth in the questions box, you guys. So in the chat window is where you'll find that hot link. If you're watching this on tape delay, you're obviously going to have to pause this webinar and punch that into your URL. All right. So without further ado, you can take advantage of that. Also, watch my daily market commentaries. Check us out on Facebook. And without further ado, I want to thank you guys all. In later webinars, I'll drill on different option components, how, when, where, and why I'm trading those. This is also that link for the webinar that is going to have to be punched into your URL manually. If you have any questions or have any comments or want me to do a webinar on something, reach out to us at 310-598-6677 or email me at trading@protraderstrategies.com. All right. So that's about all I got for you guys. Other than, if you can't take that, take it easy. Take care, guys.